Welcome back. John A.G. here. All right, today is not a normal gold story. This is not just another chart, another candle, another headline about record highs. This is a balance sheet story. This is a trust story. This is the kind of setup where one side of the market thinks everything is fine and the other side is quietly moving toward assets that do not need anyone's promise to survive. And that is where silver miners enter the conversation. Not because they are magic, not because every company will win, not because a rising metal price saves bad management, but because when capital starts questioning paper claims, the assets tied to real metal can suddenly become much more important than the market expected. Before we get into it, a quick request. My stats show many of you watch these videos but still have not subscribed. So if you value this work, support the channel, subscribe, and drop any short comment, even a simple "Our John AG," so the algorithm knows this content matters. Now here is the problem. The world is sitting on an enormous pile of financial wealth. Boston Consulting Group estimated global financial wealth at a record $305 trillion in 2024. That number matters because gold, silver, and miners are tiny compared with the ocean of capital sitting in stocks, bonds, deposits, funds, private credit, and other paper claims. So when people say gold demand is big, we need to be precise. It is big, yes, but it is not $5 trillion a year. The World Gold Council reported total gold demand in 2025 at 5,002 tons, with a value of about $555 billion. That is a record, but it is still small compared with global financial wealth. And that is exactly the point. If even a small part of the paper world starts looking for hard asset exposure, the metal market does not need the whole ocean to move. It only needs a wave. Now, this does not automatically mean the dollar dies tomorrow. It does not automatically mean every stock crashes next week. And it does not automatically mean any silver miner with a good story becomes a winner. That is not analysis, that is noise. The real question is different. What happens when trust and credit starts weakening? At the same time, physical gold demand is rising, central banks are still buying, private credit is becoming more important, and governments are running debt loads that are no longer small enough to ignore. That is the setup. Gold sits at the center of this because gold is not someone else's debt. A bond depends on repayment. A bank deposit depends on the bank and the system around it. A stock depends on earnings, valuations, liquidity, and confidence. Gold is different. It is not perfect. It produces no cash flow. It can fall hard. But physically held gold does not need a counterparty to keep its basic monetary character. There is a reason the old J.P. Morgan testimony still gets quoted. The clean transcript line was simple. Money is gold and nothing else. Now, in the modern legal system, that does not mean gold coins are automatically legal tender for every debt. U.S. law says United States coins and currency, including Federal Reserve notes, are legal tender. So we have to separate legal tender from monetary character. Cash is the legal payment instrument. Gold is the asset that carries no promise from a debtor. And this is where most people get confused. They ask, if gold is so important, why do professional portfolios own so little of it? Well, because institutions are built around rules, benchmarks, compliance, liquidity, and career risk. A manager can be wrong with everyone else and survive, but being early, different, and right only after 2 years of pain can still get you fired. That is why the precious metals space can stay ignored for years and then move violently. It is not because the market suddenly discovers a new element. It is because the capital structure around it changes. Look at China. We know the People's Bank of China has been adding official gold. The World Gold Council reported that China bought gold for the 17th consecutive month in March 2026, lifting official holdings to 2,313 tons. That is the confirmed number. Anything beyond that, hidden state holdings, military holdings, unofficial channels, has to be treated carefully. Maybe there is more, maybe there is not. But the verified point is already important. China has been increasing official gold reserves. And China's relationship with gold is not random. The People's Bank's central role in Chinese gold and silver markets was validated by the 1983 regulations, which put the central bank in charge of regulation, purchase, distribution, and national bullion reserves. So when China buys, it is not just another retail buyer walking into a shop. It is a state-level monetary signal. Now ask yourself this. If central banks are still buying gold, if investors are buying gold ETFs and bars, and if global wealth is sitting mostly in paper claims, what happens to the companies that actually own metal in the ground when the market decides hard assets deserve a higher multiple? That is why silver miners can become explosive. Silver is not only monetary, it is industrial. It lives between two worlds. When investors want hard assets, silver can move. When industry needs supply, silver can move. And when silver moves, miners with real reserves, controlled costs, clean balance sheets, and strong jurisdictions can move even faster. But weak miners can still fail. This is not a blind lottery ticket. This is a filter game. The market is not rewarding every miner. It is preparing to separate companies with real operating leverage from companies selling stories. That separation is where opportunity can appear. Now let us talk about the dollar system. You will hear dramatic claims like, the petrodollar is dead. That is too simple. There was no official agreement forcing all Saudi oil to be sold only in dollars, and serious analysis has made that clear. But there is a real trend underneath the exaggeration. More countries are experimenting with payment diversification. More trade is being discussed outside the old channels, and more central banks are trying to reduce single currency dependency. So the dollar is not dead, but the world is no longer treating it with the unquestioned confidence it had in previous decades. That distinction matters, and the U.S. is still deeply connected to foreign capital. Treasury's latest survey measured foreign holdings of U.S. securities at $35.334 trillion as of June 30th, 2025, including $19.843 trillion in U.S. equities. So, foreigners have not abandoned U.S. assets. The real risk is not abandonment today. The risk is crowding. Too much global capital sitting in the same assets, depending on the same liquidity, trusting the same market structure. If that trust wobbles, the exit door is not built for everyone at the same time. Now add the U.S. fiscal picture. Fiscal data reported average fiscal year 2025 GDP at $30.36 trillion, while federal debt stood at $37.64 trillion, a debt-to-GDP ratio of 124%. Again, that does not mean immediate collapse. The United States still has deep capital markets, reserve currency status, and enormous institutional strength. But debt at that size changes the conversation. It makes interest costs, deficits, refinancing, and confidence part of every market cycle. And this is the part investors hate hearing. A market can look strong while the foundation is getting more fragile. Equities can hit highs, credit spreads can behave, volatility can stay calm, and underneath that calm, leverage can build quietly. Private credit is a major example. The IMF has warned that financial stability risks remain elevated, with stretched valuations, sovereign bond pressures, and the growing role of non-bank financial institutions. The Financial Stability Board has also pointed out that regulatory and statistical data often lack a clean category for private credit funds. Translation: a huge part of the credit machine is harder to see than public markets. That does not mean private credit is automatically a bomb. It means stress can hide longer. And when stress hides longer, the adjustment can be sharper when it finally appears. This is why precious metals matter, not because they solve every problem, but because they represent a different kind of exposure. They are not someone else's growth projection. They are not a private valuation mark. They are not a covenant hidden in a loan document. They are real assets priced every day in a world slowly remembering counterparty risk. And silver miners add another layer. They are equities, yes, so they can get hit in broad sell-offs, but they are equities linked to an asset class that can benefit when confidence in paper claims weakens. That makes them volatile. It also makes the right ones powerful in the right phase of the cycle. So what should we watch? First, watch gold demand value and ETF flows. If demand stays strong even at higher prices, that tells you buyers are not just bargain hunting. They are reallocating. Second, watch China's official gold additions. Do not build a thesis on rumors. Build it on confirmed reserve changes and policy behavior. Third, watch silver's relationship to gold. If gold leads first and silver begins to outperform later, that often tells you the precious metals move is broadening. Fourth, watch miners. Not the loudest names, not the most promoted names. Watch margins, costs, debt, jurisdiction, reserve quality, and whether management can actually execute. And fifth, watch credit stress. If private credit, banks, or consumer loans start showing more cracks while metals remain strong, that is not random. That is capital searching for safety and torque at the same time. Now, let me be very clear. This is not a call to chase everything green on the screen. Chasing late is how investors turn a great theme into a bad personal result. If a miner has already run too far, too fast, the best move may be patience. Strong themes still pull back. Strong bull markets still shake people out. The question is not, can it go up today? The question is, does the structure still support higher prices over time? And right now, the structure is not normal. We have record-level global financial wealth. We have record gold demand value. We have official Chinese buying. We have high U.S. debt relative to GDP. We have huge foreign ownership of U.S. securities. We have private credit growing in areas that are not fully transparent. And we have a market still pretending this is just another cycle. Maybe it is. Maybe the system absorbs everything again. Maybe the dollar remains dominant, equities keep climbing, private credit stays controlled, and metals cool off. But if it is not just another cycle, then the assets tied to real metal may not behave like ordinary assets. Gold may be the signal, silver may be the accelerator, and select silver miners may be the torque. That is the core idea. If you are already positioned and you have seen results, share your success in the comments. Not to brag, but to help other viewers understand what discipline, patience, and research can actually do in this sector. And if you are not positioned, do not panic. Panic buying is not strategy. Start by understanding the structure. Look at balance sheets, look at costs, look at jurisdiction, look at management. Look at whether a company benefits from higher silver prices or simply talks about them. Because in a real metal cycle, the market does not only reward exposure, it rewards quality exposure. Here's the cliffhanger. If gold continues absorbing institutional attention, and if silver begins to catch up, the miners will not wait for everyone to feel comfortable. Markets do not ring a bell when the rotation begins. They move first. The explanation comes later. So the next time someone says, "Why are metals rising if everything looks fine?" Remember this. Markets often look fine right before they admit they were not fine at all. The real story is not just price. It is trust. It is liquidity. It is debt. It is physical ownership. It is the quiet shift from promises toward assets. So here's my question for you. Do you think gold is already warning us about the credit system? Or do you think this is just another overhyped metals cycle? Drop your view in the comments. And one more thing. If you have built success in this market, share the lesson, not just the profit. What did you buy? What did you avoid? And what rule protected you from making emotional decisions? Because 2026 may not reward the loudest investor. It may reward the prepared one. That is why the safest approach is not hype, not fear, and not blind loyalty to any ticker. It is a disciplined watch list, confirmed data, position sizing, and patience when volatility tries to force emotional decisions from investors. Subscribe, stay sharp, and keep watching the data. The move that matters is usually the one that starts before the crowd understands it.